You're listening to All Things Investing, the podcast that makes money talk simple, smart, and actionable. Whether you're just getting started or leveling up your portfolio, we've got you covered with tips, strategies, and no-fluff advice. Let's grow your wealth, one episode at a time.
So if you took $19, which is, essentially just the price of a couple of premium coffees or maybe a quick fast food lunch, and you hid it under your mattress every single week, you would have roughly $39,000 by the time you retire after a 40-year career.
Right, yeah. Nice little pile of cash.
Exactly. It's a nice little pile.
Yeah.
But if you take that exact same $19 and you tweak one single variable in how you handle it, that $39,000 explodes into roughly $200,000.
Oh, it's what?
I mean, it's the same amount of your money, same amount of time, completely different reality. So, welcome to this deep dive. We are looking at the hidden mechanics of how pocket change quietly buys financial freedom. And we are basically dismantling the myth that investing is this exclusive club with a massive cover charge.
It is a pervasive myth, and honestly, it's incredibly damaging. People look at the financial landscape, and they feel like they are standing outside a VIP lounge, just looking through the glass.
Yeah.
The prevailing belief is that if you don't know the secret handshake, or if you don't have thousands of dollars in disposable income, you are just left out in the cold.
Well, we have an incredible stack of sources today to help us tear down that velvet rope. I was looking through the data we pulled together, expert research and articles from Fidelity, deep analytical insights from the Financial Industry Regulatory Authority, which you might know as ANRA, and a very practical piece from National Debt Relief. Plus, we've got this incredibly detailed transcript of a 19-step investing framework for absolute beginners.
That framework is gold. Yeah.
Yeah, it really is. And across all of these distinct sources, a singular, powerful theme emerges, which is you do not need to be rich to start.
Right, because the barriers to entry are largely psychological. They're not financial. And that is the crucial takeaway from the institutional research here. When people are paralyzed by the market, it isn't usually because they literally have $0 to their name.
Yeah.
It is because they suffer from what behavioral economists might call the I need thousands to start fallacy.
Okay, let's unpack this. I want you, the listener, to picture your paycheck. The money hits your account on a Friday, and then the brutal realities of life just start gnawing away at it.
Oh, yeah. Every time.
Right. The rent or mortgage gets pulled, the groceries, the utilities, the car payment, the insurance premiums. By Tuesday, you are staring at the remainder. What if there's only a tiny, almost laughable sum left over?
Like the $19.
Exactly. Let's use our mattress example. Let's say $19 a week. Most people would look at that leftover $19 and think, well, I guess I'm not an investor. I'll just buy a pizza.
And that pizza is the literal manifestation of the psychological trap. I mean, when beginners conceptualize the stock market, they don't picture $19. They picture Wall Street millionaires.
Suits and ties, yeah.
Right. They picture massive hedge funds, sophisticated algorithms, people trading blocks of millions of dollars in a single click. So when they look at their own $19, the contrast is so vast that the small amount feels inherently futile.
It just feels pointless.
Exactly. This creates a profound psychological barrier, resulting in absolute paralysis. They tell themselves, I'll start when I have a real job, or I'll start when I pay off all my student loans, or, this is the big one, I'll start when I have $5,000 in extra cash sitting around.
Well, wait, let me play devil's advocate here for a second. Isn't that logical? If I only have $19, the transaction fees alone, back in the day, would have eaten that alive. Isn't the idea of waiting for a larger sum just basic prudence?
Well, historically, yes. There was a kernel of truth to that when stockbrokers charged hefty commissions for every single trade. But the infrastructure of investing has completely revolutionized over the last decade.
Right, the apps and everything.
Exactly. Zero commission trading and fractional shares exist now. You can literally buy a slice of a stock for $1. So the infrastructure changed, but human psychology hasn't updated its software. Because that mythical day where someone suddenly has $5,000 in extra unallocated cash rarely arrives, they simply never start.
It's an all-or-nothing mindset. If I can't be a whale, I'm not even going to swim in the ocean. But this is exactly why the sources focus heavily on a hyper-specific, highly accessible number like $19. It's an absolute game changer for human behavior.
It really is.
By setting the bar at $19, it completely removes the barrier to entry. It changes the internal narrative. You shift from saying, I can't afford to invest, I am priced out of the economy, to saying, wait a minute, I could skip one small purchase a week.
And that democratizes the action of building wealth. The $19 itself functions almost like a psychological Trojan horse. It is a small enough amount to sneak past your own defenses, your own anxieties about money. You don't have to overhaul your entire budget or live on rice and beans to find $19.
Right.
And once that money is in motion, something fascinating happens to your self-perception. Your identity shifts. You stop being someone who is, hoping to invest one day, and you become, literally and legally, an investor. The amount doesn't dictate the identity, the action does.
Breaking that psychological barrier is step one. Getting over the starting line is huge. But I know what you're probably thinking right now as you listen to this. You're looking at that conceptual $19 and thinking, okay, great, I have an investor identity now. But what can $19 actually do? Am I just playing a microscopic game here, or is this going to move the needle on my actual life?
It is the most natural, grounded question to ask. And the reason we ask it is because human brains are generally quite bad at intuitively understanding exponential growth.
We're terrible at it, yeah.
We are wired for linear growth. If I put $19 in a jar every week, I know exactly how much is in the jar. I just multiply the weeks by 19. But investing does not operate like a jar. It operates like an ecosystem.
I want to push past the tired analogies here, too. We always hear, investing is like planting an acorn and waiting for an oak tree. But that doesn't explain the mechanism of how the money grows. I better think of it like a snowball rolling down a snow-covered hill.
That is a much more mechanically accurate metaphor. Compounding, which is the engine of wealth we are talking about here, is exactly like that snowball. When you start, the snowball is the size of a golf ball. You roll it over once and it picks up a tiny dusting of snow.
Right.
That is your initial return on investment.
But the magic isn't the first rotation. The magic is what happens to the surface area of the snowball.
Precisely. Because the snowball is now slightly bigger, it has more surface area. On the next rotation, it picks up a slightly larger amount of snow than it did the first time. The market pays you back over years, not days. When you invest, your money earns returns. But then, those returns earn their own returns.
The new snow picks up more snow.
Yes. Over time, the original amount you contributed, the tiny golf ball at the center, becomes a microscopic percentage of the total mass, while the compounding growth accounts for the vast majority of the volume. Time, therefore, is the critical ingredient. Time is actually mathematically more important than capital.
So let's break down the exact math from the sources, because this is where the theory becomes reality. Let's look at that $19 a week. If we multiply that out, $19 a week is roughly $76 a month.
Give or take.
Right. So we are taking $76 a month, and we are going to look at example A from our source material. You take that $76 a month, and you invest it into a broad stock index fund.
And just to clarify the mechanism for a moment, an index fund means you aren't picking one company and hoping it succeeds. You are buying a tiny, automated slice of hundreds or thousands of the biggest companies all at once.
Right. You are buying the whole haystack instead of looking for the needle. Now, the historical expectation the sources use for an average annual return here is roughly 7%. Obviously, the market goes up and down, it crashes, it spikes. This isn't a guaranteed fixed rate like a savings account.
No, not all.
But as a long-term historical average, factored over decades, 7% is the benchmark they are using to illustrate the math.
And if we look at other data models, sometimes you'll see 8% or even 9% used for aggressive portfolios over 30-year stretches. But sticking to the source's slightly more conservative 7% model provides a very realistic baseline.
Exactly. So $19 a week, $76 a month, at a 7% average annual return. You do this consistently for 20 years. You never increase it. You never get a raise. You just stubbornly stick to the $19 habit. After 2 decades, your total is roughly $39,000.
Let's pause and isolate the math on that. You contributed a little over $18,000 of your own money over those 20 years.
Just under half.
Right. But the balance is $39,000. The compounding engine, the snow sticking to the surface area of the snowball, generated more wealth than your actual labor did. Your money worked harder than you did.
Here's where it gets really interesting, though. We push the timeline out further. We don't change the habit. Still just $19 a week. Still just $76 a month. But instead of 20 years, we let the snowball roll for 40 years, a full working career.
The big reveal.
Yeah. Do you know what that same $19 habit explodes into? Around $200,000? $200,000 from skipping a couple of coffees a week.
It's hard to believe until you run the numbers.
It really is.
Yeah.
I mean, the original money you put out of your own pocket over 40 years is only about $36,000. But the final account balance is nearly $200,000.
This illustrates perfectly why the human brain struggles with compounding and why time is the ultimate multiplier. The sooner you start, the more money that 7% return has to work with. In years 1 through 10, the growth feels agonizingly slow. The snowball is still small.
You're just watching it crawl.
Right. But in years 30 to 40, the snowball is so massive that a 7% return on that huge balance is generating more money in a single year than you are contributing over an entire decade. It is backloaded magic. The heavy lifting is done by the calendar.
I have to ask the obvious question, though. What if someone isn't capped at $19 forever? What if they scrape together just a little bit more? Maybe they get a promotion or they finally pay off their car loan and they have some breathing room. What happens if they can double that contribution?
The sources anticipate that exact scenario with example B. If you simply double the contribution, so instead of $76 a month, you are putting in $152 a month into that same fund, the numbers scale beautifully because you are feeding the snowball more mass early on.
Makes sense.
After 20 years, you aren't at $39,000. You approach $78,000. And after 40 years, you are looking at nearly $400,000. Small, seemingly insignificant increases in the initial habit drastically alter the decades-long result. An extra $19 a week translates into an extra $200,000 at retirement. That is the leverage of compounding.
It's staggering when you see the actual numbers, but we have to address the giant, terrifying elephant in the room here. We've seen the 40-year math, and it looks beautiful on a spreadsheet. A nice, smooth, upward curving line.
A little too perfect.
Right. But you and I both know the real stock market doesn't just go up in a straight line for 4 decades. The real market is a roller coaster. It's erratic, it crashes, it hits all-time highs, it panics over inflation reports, wars, pandemics. How do you survive that roller coaster without panicking, selling everything at a loss, and ruining the math?
That is the ultimate behavioral challenge. Math is entirely rational, but humans are deeply emotional creatures driven by loss aversion. When the market is crashing, our ancient evolutionary survival instincts kick in. The amygdala fires.
Flight or fight.
Exactly. It tells us to flee, to sell everything to stop the bleeding, and to hide our cash under the mattress where it feels safe. To survive the roller coaster, you have to adopt a specific mechanical habit before you ever bother learning the financial jargon for it.
Let's describe that habit, stripped of all the fancy terminology. The habit involves buying the exact same dollar amount of an investment on a fixed, unyielding schedule. Let's say the first of every single month, like clockwork.
Unwavering.
Yeah, and you do this completely ignoring the news. You ignore whether the talking heads on television say the market is crashing into a recession or soaring to unprecedented bubbly heights.
Yeah.
You just blindly, stubbornly execute the purchase.
This habit is powerful because it acknowledges a fundamental truth, which is human beings cannot predict the future. The greatest, most highly compensated minds on Wall Street cannot consistently predict the short-term highs and lows of the market.
They really can't.
No. Trying to time the market, which means trying to buy at the absolute bottom when things are cheap and sell at the absolute top when things are expensive, is a fool's errand. It is statistically impossible to do consistently over 40 years. By committing to a fixed schedule and a fixed dollar amount, you are building a system that doesn't require you to be a psychic.
Okay, to really bring this concept to life, we need to look at this fantastic narrative example from the Fidelity article. I want you to imagine you are investing $25 every single month into a fictional company. Fidelity calls it Qualified Robotics Scientific, or QRST for short.
I love this example.
It's so good. So you have your app set up, and on the first of the month, $25 is automatically pulled from your bank account and buys as many shares of QRST as it can. Let's map out the timeline of what this actually looks like.
It's a brilliant illustration because it forces us to look at how the mechanics function during extreme volatility, which is when most beginners make their worst mistake.
Quick break. If you're enjoying all things investing, be sure to follow, rate, and share this episode with a friend who needs to start investing smarter. Got questions? We might answer them in the next episode. Now, back to the show.
So let's start the clock. January 1st. The stock for QRST is trading at $10 a share. Your automatic $25 goes in, and it buys exactly 2.5 shares. Simple math.
Easy enough.
February 1st rolls around. The stock has gone up a bit. It's feeling healthy. It's at $12.50 a share. Your $25 goes in, and because the stock is more expensive now, your fixed amount only buys 2 shares.
Right.
March 1st, the stock drops back down to $10. Your $25 buys another 2.5 shares.
And notice the behavior up to this point. You haven't done any fundamental analysis. You haven't checked the stock ticker on your phone. You haven't felt any stress. You just let the $25 do its job.
Right. But then, on March 15th, QRST drops a massive press release. They announce a revolutionary product, a robot dog.
Oh, boy.
And this isn't just a plastic toy. This robot dog fetches your shoes, it finds your lost keys, it patrols and protects the yard at night, and you never have to take it for a walk in the freezing rain or feed it kibble.
Sounds incredible, honestly.
Right. The public goes absolutely wild. By April 1st, your scheduled investment day, the stock has skyrocketed to $50 a share. It has quintupled in value. Your trusty $25 goes in. But now, because the stock is incredibly expensive, your $25 only buys half a share.
Let's analyze the psychology here for a second. The human instinct on April 1st would be to pour your entire life savings into the stock because it's hot. Your neighbor is talking about it, the news is talking about it, the fear of missing out is peaking.
FOMO is real.
It is. But your habit restrains you. You only spend this equal $25. You are artificially limiting your exposure at the top of a bubble.
And it turns out it's a very good thing you were restrained, because by May, total disaster strikes. A terrifying news report comes out. A rogue robot dog experienced a software glitch and fetched an owner's foot instead of their shoe. Just an absolute PR nightmare. Lawsuits are threatened. The stock completely plummets. It crashes all the way down to $8 a share. Panic is everywhere. So when your automatic investment hits on the 1st of the month, your $25 suddenly has massive buying power. It scoops up 3.125 shares.
Again, look at the behavioral instinct during a crash to $8. The instinct is to stop investing immediately. The instinct is to run away because the company looks completely doomed.
Get out while you can.
Exactly. But the automatic habit forces you to buy when there is blood in the streets, which is historically when equities are at their absolute cheapest. You are buying on clearance without having to muster the courage to do it manually.
And then we get the final twist in our corporate drama. By September, investigative journalists discovered that the dog bite story was a total hoax. A rival robotics company planted the story with a fake video. The truth comes out, the public's faith is completely restored, and the stock rises rapidly again.
What's fascinating here is if you take a step back and look at the underlying mechanics of the story, the math has worked beautifully in your favor without you having to make a single strategic, stressful decision. By investing a fixed amount of $25 every time, you naturally automatically bought fewer shares when they were wildly expensive, like when they hit $50, and you bought more shares when they were dirt cheap, like when they crashed to $8.
Because your dollar amount was fixed, the share price dictated the volume. High price equals low volume. Low price equals high volume.
Exactly. This naturally lowers your average cost per share over time. You are essentially tricking your own portfolio into buying low and holding back when it's high without ever having to time the market or predict the news cycle. It bypasses human panic entirely.
It's such an elegant solution to our own emotional flaws. And now that we've seen how the habit works to protect you from the wild swings of the robot dog market, what is the actual, intimidating jargon name for this strategy?
So this habit investing a fixed dollar amount at regular intervals regardless of the asset's price is called dollar cost averaging, or DCA for short. It is the absolute cornerstone of almost all successful long-term passive investing strategies.
So we've broken down the $19 math over 40 years. We've explained the mechanics of the snowball. We've explained the dollar cost averaging habit that keeps you sane during market crashes. Now, the listener needs a practical blueprint to actually execute all of this. Our source material provides an extraordinarily comprehensive 19-step framework for the beginner. I want to walk through this because it takes all the high-level theory we just discussed and turns it into a concrete action plan. But we aren't going to just read a list. Let's group these logically.
I agree. This framework is highly structured, and it wisely begins with laying a protective foundation before a single dollar is ever exposed to the risks of the stock market.
Let's look at Phase 1, which covers steps 1 through 4. Think of this as the groundwork and setup. Step 1 is simply to decide your purpose and your time horizon. The math changes radically if you are saving for a house down payment in 5 years versus retirement in 30 years. A 5-year timeline doesn't have time to recover from a robot dog crash.
Very true.
Step 2 is building an emergency fund of 3 to 6 months of basic living expenses in cash. Now, let me pause and challenge this. Why are we telling the listener to hoard cash in a low-yield bank account if we just spent the last 20 minutes proving that compounding in the stock market is so incredibly powerful? Isn't holding cash counterproductive to the whole snowball concept?
It seems highly counterintuitive at first glance, but the emergency fund is actually the mechanism that protects the investments. What happens if life throws a severe curveball? Say your car's transmission blows, or you have an unexpected medical emergency that costs $4,000. If you do not have a cash emergency fund, you will be forced to sell your investments to cover that cost.
And what if your car breaks down during the exact month that the robot dog hoax hits and your stock is down at $8?
That is the nightmare scenario. You are forced to sell your shares at a massive loss just to fix your car. You turn a temporary paper loss into a permanent realized loss. The emergency fund acts as a defensive moat around your investment castle. It allows your investments the uninterrupted, peaceful time they need to compound without being raided for daily emergencies. The cash protects the compounder.
That perfectly clarifies the why behind the cash. Moving on to step 3, pick a simple core investment. The sources highly recommend a broad market index fund or an exchange-traded fund, commonly called an ETF. But let's actually explain how that works. You aren't picking individual winning companies. What is an ETF mechanically?
Think of an ETF as a massive financial variety pack. Instead of taking your entire paycheck and betting it on one giant box of a single risky cereal, you buy the variety pack that contains a tiny fractional box of every cereal in the grocery store.
Oh, I like that.
Right. If one company, one specific cereal goes bankrupt and drops to zero, it doesn't ruin your portfolio because it was only a microscopic fraction of the overall basket. You are betting on the entire grocery store staying in business, not one specific product. It provides instant diversification.
And step 4 is just opening the right bucket to hold those variety packs. If your job offers a 401k, especially with a company match, start there. A match is literal free money. If not, look into an individual retirement account, an IRA, or just a standard brokerage account. It's just the tax-sheltered bucket that holds the funds.
Once that foundation is laid, the moat is built, and the bucket is chosen, the framework shifts to phase 2, which is the engine of consistency. This encompasses steps 5 through 11, and it's where the actual wealth generation mechanics take over.
Step 5 is arguably the most critical mechanical step in the entire 19-step process. Set up automatic contributions. Do not rely on yourself to manually log in and transfer the money every month.
You won't do it.
You will forget. You will talk yourself out of it because you saw a nice pair of shoes online. Step 6 is to start sensible. This is where our $19 a week habit comes in. Don't pledge to invest $500 a month if you are going to starve trying to meet that goal. Start small, prove the concept to yourself, and make it sustainable.
Step 7 ties back to our variety pack analogy. Diversify simply. You don't need 20 different complex specialized funds tracking obscure sectors. 1 or 2 broad market funds provide enough diversification to massively reduce your overall risk. And step 8 is absolutely critical and often overlooked by beginners' watch costs. You must pay attention to the expense ratios of the funds you buy.
Let's dig into that. What exactly is an expense ratio and why does it matter so much?
An expense ratio is the annual fee that the people managing the ETF charge you for bundling all those stocks together. The sources heavily emphasize finding funds with expense ratios well under 0.20%. High fees act like a silent parasite on your compounding returns.
Because the fee is deducted every year, regardless of whether the market goes up or down. Right?
Exactly. And because of the compounding math, a high fee doesn't just cost you the money you paid, it costs you all the future exponential growth that money would have generated. Over 30 years, a 1% fee, which sounds tiny, can consume 25 to 30% of your potential wealth.
That's insane.
It is staggering. Keep it cheap. Vanguard, Fidelity, Schwab, they all offer broad funds with fees close to zero.
That makes step 9 obvious. Don't chase hot stocks. Don't chase the latest tech trend or the crypto coin your neighbor's bragging about at a barbecue. And step 10 brings us back to our core strategy use dollar cost averaging. But I want to tie this back to a very specific piece of analysis from the National Debt Relief Source. They pointed out a vital caveat about DCA. They noted that dollar-cost averaging works best with diversified ETFs or index funds, but it is actually highly risky to use DCA on individual stocks.
Yeah.
Why the distinction?
It's a profound mathematical distinction. If we connect this to the bigger picture, if you use dollar cost averaging on a broad index fund, the variety pack, you are essentially betting that the overall global economy, human innovation, and corporate productivity will continue to grow over the next few decades.
Right.
Historically, that is an incredibly safe bet. If the entire market dips, it eventually recovers as the economy expands.
Right, because humanity keeps inventing things and buying things.
Precisely. However, if you use DCA on a single individual company, you lose that guarantee. Individual companies go bankrupt all the time. Blockbuster, Enron, Lehman Brothers. If a single company is fundamentally flawed and the stock price drops to zero, it never recovers.
It's just gone.
Yeah.
Oh.
If you are blindly dollar cost averaging into a dying company, you're just throwing good money after bad all the way down to the bottom. You are averaging your cost down to zero. DCA assumes a long-term recovery, which is a property of entire broad markets, not necessarily individual corporations.
That is a phenomenal caveat that most beginner guides skip over entirely. Finally, for this phase, Step 11, rebalance yearly. Let's explain how this works mechanically. Say you want a portfolio that is 80% stocks for aggressive growth and 20% bonds for stability. Over a great year, your stocks grow incredibly fast, and suddenly they make up 90% of your portfolio. You are now taking on more risk than you originally intended.
Rebalancing is the act of forcing your portfolio back to its original target. Once a year, you look at it. If stocks are at 90%, you sell some of those winning stocks, and you use the cash to buy more bonds to get back to 80-20.
Ah, right.
What is brilliant about rebalancing is that it inherently forces you to follow the golden rule of investing: buy low and sell high. You are automatically trimming the assets that have become expensive and buying the assets that have lagged. It is an automated contrarian strategy.
Which brings us to the final phase, Phase 3, encompassing steps 12 through 19. This phase is all about maintaining a long-term mindset over the decades.
This is where we shift from building the machine to doing the routine maintenance that keeps it running for 40 years.
Let's flow through these long-term maintenance steps. Step 12 reminds us to maximize tax advantages. We briefly mentioned 401ks and IRAs, but the mechanism here is crucial. If you invest in a standard account, you get taxed on your gains every year. The government takes a bite of your snowball.
A big bite, usually.
Yeah. But in a tax-advantaged retirement account, the money grows completely tax-free for decades. The snowball rolls unimpeded. Step 13 is simple. Keep it simple. Don't try to outsmart the system with complex options trading or leverage derivatives as you get older and think you are an expert. The boring basics still work.
Step 14 is adjusting your risk as you age. When you are 25, you have 40 years to recover from a market crash. You can afford to be highly aggressive in stocks. But when you are 64 and retiring next year, you cannot afford a 50% drop in your life savings. You transition the portfolio mechanically toward more stable assets like bonds and treasury bills to lock in the wealth you've built.
Step 15 is one of my favorite behavioral hacks plan for life changes, specifically by investing a percentage of your raises. When you get a bump in salary, it is incredibly easy to just buy a nicer car or eat out more. It's called lifestyle creep. By committing to invest half of every raise before you ever get used to spending it, you artificially cap your lifestyle creep while massively accelerating your compounding timeline.
The final steps are really about psychological resilience. Step 16, protect from scams. If someone on social media promises you guaranteed double-digit returns with zero risk, run the other way. Risk and return are inherently tethered together. Step 17, learn from mistakes. You are human. You'll occasionally panic or make a poor choice. The key is to review it, learn the behavioral trigger, and adjust calmly rather than abandoning the system entirely.
Exactly.
And step 18, track your progress simply.
Don't check your portfolio every day. Checking it daily just spikes your cortisol and tempts you to tinker. Check it once a quarter. Let the machine work in the dark. And finally, step 19, which might be the most important for human motivation. Celebrate milestones. When you hit your first $1,000 saved, take a moment. Go out for a nice dinner. Acknowledge the discipline. You have done something most people only talk about doing.
It reinforces the positive behavior. Your brain registers the dopamine of the milestone, which fuels the discipline required for the next decade of investing.
So we have this blueprint, and it sounds absolutely flawless. Start small, automate it, use dollar cost averaging, wait 40 years, become wealthy. But every single strategy in the financial world has a blind spot. What are the actual mathematical limitations of dollar cost averaging? It can't be perfect.
It is not perfect, no. And the sources from FINRA and National Debt Relief provide excellent, highly balanced analysis on this exact topic. The main pushback comes in what is known in financial circles as the lump sum debate.
Let's frame this debate with a real-world scenario. Let's say, miraculously, someone gets a $10,000 inheritance from a relative, or they land a huge year-end bonus at work. They suddenly have a chunk of capital. The question is, should they take that $10,000 and dump it into the market all at once today as a lump sum? Or should they use dollar cost averaging and spread it out, maybe investing $1,000 a month for the next 10 months to reduce their risk?
The FINRA article addresses this directly, and the math is quite illuminating. While dollar cost averaging is undeniably brilliant at minimizing risk and limiting your emotional panic during market declines, it comes with a built-in mathematical flaw known as opportunity cost.
Explain opportunity cost in this context.
Historically, the stock market spends significantly more time going up than it does going down. We call a rising market a bull market. The overall trajectory of the global economy is upward. If we are in a long-term bull market, and you are holding $9,000 in cash on the sidelines in a bank account, waiting to slowly drip it into the market month by month, that cash is earning almost nothing while the market itself is climbing higher and higher.
I see. So holding the cash back as a defensive measure means you are missing out on the gains of those $9,000. By the time month 10 rolls around, you are buying into the market at a much higher price than if you had just bought it all on day one. You paid a premium for emotional comfort.
Exactly. Statistical studies consistently show that roughly 2/3 of the time, investing a lump sum immediately will produce higher long-term returns than spreading it out via dollar cost averaging. The cash drag on the sidelines lowers your overall return because the market generally goes up. The math favors the lump sum.
But the psychology doesn't.
Right. The psychology favors DCA. Because if you invest the $10,000 today and the market crashes 20% tomorrow, you will feel a profound sense of regret. FINRA points out that DCA is often a tool for regret minimization rather than absolute mathematical optimization.
There is also another structural limitation mentioned in the source's brokerage fees. If you are paying a flat fee every single time you make a trade, making 12 small trades a year is going to rack up way more fees than making one giant lump sum trade. Now, many modern brokerages have zero-fee trades for index funds, but it's something you have to verify. Otherwise, you are bleeding money to your broker with a high-frequency DCA strategy.
However, we must clarify a massive vital nuance here that the sources point out because it changes the entire context of this debate for the average listener.
Okay, what is it?
The entire opportunity cost argument, the idea that you shouldn't hold cash on the sidelines, does not apply to how most people save for retirement, specifically in a 401k or through regular paycheck contribution.
Why is that? Why doesn't the lump sum math beat the 401k?
Because in a 401k, you are not holding a pile of cash back. You don't have a lump sum of $10,000 sitting in a checking account that you are stubbornly, slowly dripping into the market. You are investing the money exactly as you earn it, straight out of every 2-week paycheck.
Oh, right.
You couldn't invest next month's salary today, even if you wanted to, because your employer hasn't paid you yet. Therefore, paycheck deductions into a retirement plan are the ultimate, purest, most natural form of dollar cost averaging. You are getting the behavioral risk management benefits of DCA without suffering the opportunity cost of holding a large windfall of cash on the sidelines. It is the best of both worlds.
That is a crucial distinction. The lump sum debate only matters if you actually have a lump sum sitting around. If you are just investing out of your weekly cash flow, DCA is the only logical path. But this leads us to the final ultimate objection. We've gone through all this math, we've debated the strategies, but human nature is remarkably stubborn. Someone is listening right now and thinking, this is all great info, the math is compelling, but things are just tight right now. I'll just wait until I get a better job, or until I pay off my student loans, or until I just have more breathing room in a few years, then I'll start. So what does this all mean? What is the absolute worst strategy someone could choose?
The absolute worst strategy, without question, mathematically and psychologically, is waiting on the sidelines entirely. This raises an important question, perhaps the most important question of this entire deep dive. What is the true cost of delay? The sources are unequivocal about this. Waiting for perfect conditions is a financial death trap.
Because perfect conditions do not exist. The market is never perfectly calm. There is never a month where the news isn't reporting some impending crisis, an election, an inflation spike, or a geopolitical conflict. If you wait for the stars to align and for the economy to look safe, you will be waiting forever.
And by delaying, you lose the single most powerful element of the compounding math we discussed earlier. You lose time. Let's revisit our snowball. If you wait 10 years to start that $19 a week habit, you haven't just saved yourself 10 years of small contributions. You have chopped the massive, explosive compounding growth off the absolute back end of your timeline.
You're losing the biggest years.
Yes. You aren't losing the tiny snowball of year 1. You are amputating the avalanche of year 40. You have severely crippled the final outcome. The mathematical penalty for losing a decade of compounding is astronomically high. It is the most expensive mistake a beginner can make.
So the solution isn't to wait until you are braver or richer or smarter or until the news cycle calms down. The secret sauce to the $19 habit isn't willpower at all, it's automation.
Precisely. Automation is the absolute antidote to fear, procrastination, and the cost of delay. By setting it and forgetting it, you remove the flawed, panicky, emotional human element from the equation entirely. You don't have to wake up, read a terrifying headline about the global economy, bravely log into your brokerage account, wrestle with your own doubts, and manually click buy. The system does it for you. It executes the plan while you are sleeping or drinking coffee or walking the dog.
You essentially build a financial robot that acts on your best, most rational intentions, regardless of how you feel on any given Tuesday. The automation enforces the discipline that our evolutionary brains are naturally wired to resist. It bridges the gap between knowing what you should do and actually executing it.
We've covered an immense amount of ground today. We've deconstructed the myths of wealth. We've looked at the exponential math of the compounding snowball, the psychological mechanics of dollar-cost averaging, a comprehensive 19-step blueprint for success, and the behavioral traps that keep people paralyzed.
Before we wrap up, what is the deepest takeaway from all of this? If the listener remembers only one thing, what should it be?
I think we need to leave the listener with a broader philosophical thought, stepping away from the raw spreadsheets. We spent a lot of time talking about how $19 a week can grow into $200,000 over 40 years. And that is objectively fantastic. But what if the real value of setting up this automated investment isn't just the pot of gold at the end of the rainbow? What if the true wealth is the mental bandwidth you get back today?
Oh, I like that angle. Expand on that mental bandwidth concept.
By automating your financial future, you free yourself from daily money anxiety. You free yourself from decision fatigue. You no longer have to wake up and wonder, am I doing enough? Am I falling behind? When should I start? Is the market too high right now?
It's exhausting just thinking about it.
Yeah, right. But with this, the system is running silently in the background. You have taken definitive control of the trajectory of your life. That peace of mind, that massive reduction in low-grade, constant financial stress, that is a form of wealth that you get to enjoy immediately. You don't have to wait 40 years to feel it. You feel it the very week you set the system up.
That is profound. It's not just about future money. It's about present peace.
So, to bring this all the way home, I am giving you, the listener, one concrete homework assignment before our next deep dive. I don't want you to just listen to this, nod your head, think that makes sense, and then change the channel. I want you to act. Here is your actionable challenge. Open a brokerage or retirement account this week. Do 15 minutes of research, pick one low-cost broad market index fund like we discussed, and set up an automatic weekly transfer of just $19 or $25 or whatever small number bypasses your anxiety. Just get the machine running. Once the machine is running, you will be amazed at how quickly it becomes an invisible, effortless part of your life. You won't even miss the $19, but your future self will be endlessly grateful for it.
You started this deep dive looking at an intimidating, murky financial landscape that felt like an exclusive club. Hopefully you now see that the door is wide open. The secret handshake is just consistency and time. Remember, steady, repeatable, automated progress always beats the noise. Thank you for taking this deep dive with us. See you next time.
Thanks for tuning in to All Things Investing. Don't forget to subscribe so you never miss a tip that could boost your financial future. Follow us on TikTok, YouTube, and wherever you get your money advice. Until next time, keep investing in yourself. Financial disclaimer. The information provided on the All Things Investing podcast is for educational and informational purposes only. It is not intended as financial, investment, tax, or legal advice. Always do your own research and consult with a licensed financial advisor or other qualified professional before making any investment decisions. The views and opinions expressed are those of the host and guests, and do not constitute official recommendations. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. By listening to this podcast, you agree that the host and associated parties are not responsible for any financial decisions you make based on the content provided.